Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Tuesday, April 21st, 2020. We'll just cover the trade ideas here, the official trade ideas, and I'll start out with the broad market because that is one of our trade ideas via SPY and kind of a concurrent trade on QQQ. You know, we did have one recently that was stopped out, and I stated my thoughts, and I still do think and so far we're seeing that that tech is, I think, poised to play a game of catch-up. It may not outperform, it could outperform, but I think it will keep pace to a lesser degree on the next drop in the market, whether that's already begun or not. And just to reiterate, if you haven't caught, my logic for that or rationale is I believe there's been a gross mispricing in the technology sector in general. And of course, I am generalizing for the same reasons that I said before. It would, actually hold up a little better and bounce a little better on this bounce. Is that, it got sold down. Everything got sold down in the first leg down in the bear market, and technology, rightfully so. They're not exposed to the consumer. They don't have most, and again, I'm generally speaking, most technology companies don't have retail storefronts. They're not running restaurants. They're not running stores in the shopping mall. Yes, does Apple have walk-in stores? Sure, but again, the majority there, they can function fine without those stores. They can sell, as they do, most of their products online anyways. And again, Microsoft, things like that in the cloud, chip equipment makers and chip producers down the line. So I think you guys know what I'm saying there. So, however, like I said, so we've seen a sharp rally, and again, rightfully so. We were long QQQ, or officially, I think, what do we have? XLF. We had some other things off the bottom. QQQ and SPY was an unofficial trade, and official. But where I'm going with that is I think now that we've seen just a lot of money come back, I think it's overdone. I think it's misplaced faith in these tech companies. Yes, they are immune to an extent. Their business model it's not impacted as much from people staying at home because they'll still order those products online. They'll still use cloud software, your Dropbox, Microsoft, and Amazon Cloud Services, stuff like that. But what they're not immune to, as I said, is the business cycle. And so I've spent a lot of time talking about that, showing that in other videos. Just wanted to reiterate that tech is a very high growth, fast growth rate industry. So during the bull market, like the last one from 2009 to 2020, tech will and often does outperform just about every other sector in the S&P 500. It grows faster than utility companies, faster than REITs, faster than steady eddy, consumer durables and things like that. But the flip side of it, because of that fast growth rate and the way their business models work, they tend to fall a lot more when the business cycle turns. So that's why, and I say that because somebody asked. I just was catching up on questions, and I made a comment, or somebody asked about Autodesk, which I'll get to in a minute. It's one of our short trades. Hey, Randy, you've been making a lot of cases fundamentally lately, as well as technically, and do you have a fundamental case for Autodesk? And that was my reply, by the way. So just basically, solid setup. Technically, I can make a strong case, and if I am correct that even if coronavirus disappeared today, my reply said I think that there's been some wheels set into motion right now in the economy. Sort of a domino effect, if you will, that will have ripples and repercussions that are going to last for quite a bit. So my point is I think we'll continue to see a downturn in consumer spending, and that's going to impact technology companies. Pretty much everything that's sensitive to the economic cycle. The economic cycle means the ebbs and flows over the years of economic expansions and economic contractions, or booms and busts, we call it. So that's that. Let's talk about the broad markets real quick, and I'll rifle through all these trades. I won't spend too much time on any one of them. 273.39, as I mentioned, is a big level in SPY. I already covered that in today's video. When I was doing the first video, I said, look, I reversed and try to game a little bounce, and I told you, and I held to it, that I would probably the time you listen to that video or shortly thereafter, I'd be back short again, which I was, and I posted followed up under that video where my bounce targets were and where I reversed. I'll show you that now in a second, but let's just, for going forward, and again, that's active trader stuff. If you are not an active trader, pay no attention to that when I tell you I'm going to game a bounce. It's, we're talking a very small bounce, but this is what we need to see tomorrow. We closed, and this is the definition of a reaction, what I call a reaction, either a bounce or a consolidation. We got a little both. It depends on your perspective. In other words, how much of a bounce are you looking for? If you trade futures like I do, it doesn't take a big bounce. You can get a quarter point bounce on a few ES and NQ contracts and make over $1,000. So you don't need a big bounce. I'm talking quarter percentage. So 1% bounce, you can take that all day long if you're a futures trader. So, but this is, when you zoom out to the larger, a little bit larger picture, we're still in a 60-minute chart. That's a reaction. We hit it, and look at that. This isn't mere coincidence. We hugged that level, and that's a that's a weak reaction. If there were a lot of buyers in this market, or even just, let's say, more buyers than sellers, you would have had at least a bigger bounce. As I said in that video, max upside would have been a back test of the trend line, I believe, but they couldn't even do that so far. Now the day is over. We'll see what happens tomorrow. We are in earnings season. It's really getting underway here. Netflix reported tonight. We're going to have Intel on Thursday and a lot of other big companies along the way. And so you'll probably see volatility. But as of now, we still need to see 273.39. Call it 273 if you want. You can look at some of the low spikes. We need to see that level go with conviction. And I often get that question, what does that mean, go with conviction or solid? This is a breakdown with conviction right here this morning. We gapped down, big gap down below that trend line we've been watching. That's a convincing breakdown or a breakdown with conviction. And then followed through red, more selling after that first 60-minute candle. We didn't bounce back. So that's what we need to see tomorrow. Bulls can defend this level. Like I like to say, support is support unless broken. Then same story. Look for a potential back test of the trend line. That would be objective shorting entry. No guarantees it'll work out, but it's objective with a short there and a stop not too far above. And otherwise, I still favor this. We could head down tomorrow or some point, probably tomorrow. I'd like to see that, especially with what's happened, and that's what I think will happen when the tide changes. The trend goes from bullish or bearish, and you get these sell signals. In this market, things tend to move pretty fast, but it's a little too early to say we're going to have a swift move down, because for the last few weeks we've just been kind of grinding around as this market topped out and took a while. But these divergences do seem to be playing out. Nothing to write home about, because again, 3% drop, but we're just back to where we started. We shorted SPY at 273.17. We closed at 273.04. So enough said. Let's move on to QQQ, and then I'll show you where we bounced to today. QQQ, remember we had bearish rising wedge, broke down, not very impulsive, needed to take that level out, which we did to 1232, impulsive breakdown today. Then I believe, was it this morning or yesterday, said we have this gap to contend with, and I'm talking about this gap right here, big old gap, and it's certainly technically significant, because once you had it, you back tested it here and it held. And so, as I said, I believe I said this earlier today at some point, that I had expected the gap to be taken out, the top of the gap, which is that line right there. Again, that's the top of the gap. And then what it was, I said you get probably a backfill, and that would be your logical target, and you'll get a bounce. And so we bounced, and where's the most logical place? The top of the gap right there. So that's where I reversed. And what I did is I posted this earlier in the under that same thread. This is from this morning's video, or early midday. Started that at noon and mentioned that I reversed, and then I followed up so you guys would see where I went back to short after closing my shorts earlier today right off the lows, and then playing this bounce. There were two levels here, and I'll get to the futures in a second. Remember, this is that trend line in NQ, and the 84, 85 level here. I'll have to zoom in a little. I know. Oh no, I can't. This is under the comment section. These charts don't zoom. Only the ones in the posts up top. But again, you can visit that post and expand it yourself, and it'll fill your monitor. Right now, I only have a part of the monitor recording this video. And I also down here, I had that overlaid. This was a 60-minute chart up top. And it wasn't just one. I had multiple levels I was watching these reaction. This is a 2-minute chart of ES down here in the bottom, and I had these lines here for a while. 227.51 right there. It's this reaction low right there. So that's what I targeted. And then I had also a line here. These are all NQ 2-minute chart. This is part, you can see part of the 5-minute chart and a 15-minute chart and a 60-minute chart. And I had that resistance line there. That's at 85.05. So that 85.05 is roughly right with that 84 or 85 level. And again, that's what I use to reverse right there. And here I can show you. Let me clear that out, get rid of this, and try to do this real quick. Drag down here and show you those charts. If I can get rid of everything, there it is. All right, so this is it. ES, those are those same points right there. I'll grab my tool. 85.05. So there was the reversal off that level, and the 25.71 level right there. I guess that was the first tag right there. Those are those same lines. We haven't taken out today's lows, so pretty much remember we hit support at today's lows. Again, what you're looking at here, you can see ES, NQ. This is just different time frames, 2-minute, 5-minute. So if you're a futures trader tonight, you want to watch those lows, because that's where the markets SPY, QQQ, ES, and NQ, which are really all the same thing, just the ETFs and the futures, all hit support. So that's next sell signal pending. It's that simple. And as I like to say, support is support until it's taken out. So, you know, we could grind around, we could bounce, but I favor this right now, and that's where you would have your next objective short entry. Or if you're just a swing trader, if you see that happen, it's going to increase the odds that the indexes continue down to my next support levels and targets. Okay, and again, just to reiterate, there's 203.29. That's today's low. That's that big old gap support, very technically significant level on QQQ. So the bears need to see that get taken out, and that should open the door up to, you know, move down here. Some reactions along the way. It won't be a straight shot down. It could be, but that's what we need to see. And let's look at the futures, and we'll move on to the individual trade ideas. We'll get to gold, other things I haven't updated in a little while. This is the NQ, or ES, sorry, that's that ES 60-minute chart we've been focused on lately. Same levels. There's that trend line right here on ES that was taken out. We broke that last night, and that took us down here to, you know, a couple different support levels, really in this support zone that we bounced between. I highlighted that earlier today, 27.54 to 27.31, 27.31. And so we hit that, what I call support zone, when I have two support levels in close proximity, and we kind of bounce ping pong between there all day. But remember, the bigger picture was a divergence that's been building for a while, negative divergence. And it's only just started to play out, and so, you know, according to this chart and everything I see, it's most likely going to give us some more downside. But I'm staying flexible. There's you know, anything's possible. So from here, what will start to chip away at the bearish case? Well, we do have a minor downtrend line there. If you're a futures trader, you want to trade tonight, you're out on the West Coast or anywhere, you know, East Coast up to later or halfway around the world. That's a minor downtrend line. Pop above that could be the catalyst to run up here. First target would be a back test of the trend line. Plus, it should come in right around the 28.19 area. So there is a, you know, should we bounce in the futures tonight, that would be a logical target, a good place to take profits and or recycle back in short, or if you don't have a position, maybe get short. Otherwise, we may never do that because, like I said, resistance is resistance unless taken out, and it's that downtrend line right there that right now is a minor resistance level there. All right, NQ, that was ES. NQ, we took out the comparable trend line in NQ. Again, we've seen, you know, lately, at least today, more downside in the tech stocks, like seeing, and that's my expectation, is earnings are coming around. You know, half the companies aren't even giving guidance, which to me is a giant red flag. I think a fund manager should be, well, let me just hold my tongue on that. But anybody that's, you know, buying tech stocks aggressively here, you know, without, you know, any guidance from the company, again, that's fundamental. I'll trade technicals. I do factor in the fundamentals, but I think it's a dangerous thing to just assume these tech companies are going to be okay because they're not, you know, susceptible to COVID. Whereas, again, it's all about what's going on in the economy. Even if the economy opens back up, I've said this many times, it's going to be a slow reboot. You're not going to see restaurants. You're not going to, next week, if you're, you know, if your state or municipality lifts their stay-at-home restrictions, you run over to your favorite restaurant. Do you think you're going to have a 45-minute wait on Friday night like you usually do? No. You think you're going to see? Where I live, I usually can see in the right conditions, planes coming and taking off from the international airport nearby. I think I heard the first plane in weeks yesterday. Not to say they're not flying, but I can tell you on a busy day, with the right wind conditions, when the flight path is right out my office window here, you can see them coming in one after another. And so my point is, we're going to slowly get back online. That I have no doubt about, but I think a lot of damage has been done. So that's it. There's the breakdown in NQ. There's the back test. That's where I told you, that's the objective, bounce trade for a short-term trader. And what was that? Let's measure it on QQQ. It's a little easier. Same move off today's lows right here. That was good for a bounce of about 2%. And again, I'll take that all day long. It doesn't look like much when you go back to these futures charts because of the scope of these previous moves. But a 2% bounce, catching a good part of that and then going back short, it's really 4% more in my pocket on the NQs today. 2 that I didn't give back on the bounce, and 2 more that 2% that I gained on the way up, and then going back into it and riding it back down. So net, all said and done, if we get back to where I covered earlier, then that's 4% boost, if you will, if that makes sense. Okay, as promised, here's the watch list of the active trades. A couple of these were closed out today. I'll get to that. I went over this earlier. I'm just going to run through these in alphabetical order, starting here with Autodesk. We shorted the other day. That one was closed down 4.41% today. As I mentioned, looks good. Nothing really, I don't want to sit here and talk on it all day long. It's not much to talk about other than, here it is on a 60-minute chart. Just nice, beautiful little clean up trend line, well defined. This gives you a bearish rising wedge pattern. You'll see this is one of my favorite patterns, bullish falling wedges and bearish rising wedges. They're just so darn simple and so darn effective, So, that broke down. You didn't just limp. You had a big move down. You can see all these support levels here on the 60-minute chart. Fell to this 166.89 level, bounced like the market. And next leg down should take us, this is not a hard line here, but I'll just say it's more of a support zone. But again, that's 60-minute chart. This trade's based off the daily chart. I added the earnings date. I'm trying to make a point to do that on the official trades. You'll see May 28th. So what that tells us is we have an all clear. Now anything can happen. We can get stopped out of this trade. Autodesk come in with some big news headline, big contract. The market can rally and take us out of here because it's going to move up and down with the tech sector. It's a software company, but at least we know we don't have to worry about being caught on the wrong side of a earnings surprise until at least May 28th. So that gives us some room to come in. If you're an active, a more active trader, you want to hit T1, take the quick, whatever that gain would be if we get there. I don't know exactly where we shorted, but that 10% or so, sure, take it out if it looks like you might be getting close to the earnings date. Otherwise, to hit T4, if we don't get there, which it's possible but doubtful, to hit that final target within the next month or so, 5 weeks, you're probably going to have to ride through earnings. I just want to point that out, and that is up to you, each individual investor. Don't put too much in any one trade, especially when you're going into earnings, because a big surprise could cause a gap against you. Stock could rally overnight if you're short and open up big, or if you're long, the same thing. It could plunge overnight and then you can't get out of it. You can try to trade after hours. That's tough because of the fact you have to use limit orders and things are moving around. And so anyways, I just want to say right now that trade looks good based on, again, that 60-minute chart right here. When you take a bullish falling wedge or bearish rising wedge in this case, widest part of the wedge, add that to where the stock breaks down, it gives you a rough target for the wedge. But again, I'm looking for more on this one. Next up, Berkshire. Not much to add. We shorted on this bounce back to that big resistance level, about 196 and change, somewhere in there. It's based off the weekly chart. Long-term trade. This is our entry was at 195.90. We're down, stock's down to 183.80, and looking good. This is again where I figured the uppermost bounce range of the market, and Berkshire is a big component of the S&P 500. Is going to trade in line with the market, and so far, still way too early to get excited about this one, but so far it's playing out as expected. We had an initial leg down in a bear market. We had a bear market rally, what I believe to be a bear market rally, and next leg down probably has begun. And what happens there is you could chop around for a little while. Who knows? Anything is possible. Again, we could be stopped out. But what'll happen is eventually you kind of work your way down, and then as closer you get to these lows, if and when we get there, that's when the selling will begin to accelerate. That's when longs, all these people calling right now for new highs in the market, and Corona was a big scare, but it's over, and this economy is going to explode when everybody goes back to work, and blah blah blah. If this happens, what happens is you have a massive paradigm shift in thinking, and it's really just a kick in the what for those that bought, especially those that didn't come in here when it was time to buy. That where the risk reward was more attractive, especially those that chased the rally, are drinking the Kool-Aid being fed, by certain, media sites as to why you want to buy and be long, great buying up. If you bought here, not so good. And that's the way technical analysis works. It's really simple. If most people capitulated and sold out there, and then they realized they made a mistake when the stock went up 20% or whatever, and they started buying back here, it's okay right now if that's where most people bought. But when you start going lower and lower, you get all these remorseful buyers that trap longs that say, oh, wait a minute, this thing shouldn't have, the bottom was in, it should have gone up, and then they start to sell. And then shorts, are like sharks. They smell blood in the water and they pile in, and boom, boom, boom. That's why if you get anywhere near the lows in the market or in Berkshire, we'll probably take the next leg down. And, by all accounts, the same technical basis that we entered this chart. This was a weekly chart, and we only entered it a week or so ago. I'm looking at a long-term swing trade with a lot more downside, and nothing's changed technically at this point in time. If it does, I'll let you know. Like any trade, it either works out or it doesn't. Corn, there's a good example. I already covered this. I already posted an update. It was stopped out today. It's gone. So no longer an official trade. So move on to the next one. Costco, same thing as Berkshire based on the weekly chart. I saw a lot of bullish comments on this one. Oh, they just raised their dividend. They said their sales are going to go up, and maybe so. I don't know, but I like it based on this weekly chart. There's work to be done. Like I said, this is the big level. I don't even know if I have an alert set here, but when that trend line goes, that should be a good night for. Well, that trend line in 282. When 282 goes with conviction, because that'll take out the trend line, then that should be lights out for Costco. It should open the door for at least to that second target right there, and that's you're still talking on this one, if that happens, about 21% downside. So like with all these trades, you may disagree with shorting Costco, one great company. Like I told you, I love them. I spend a ton of money there. I have the executive membership because I spend so much. You buy that, pay an extra $50. They give you 2% back in addition to that 3% you get on the card or whatever it is. It's like 5% total. And again, great company, but unfortunately, the technicals say that this stock is probably looking at a major drop over the next year or so here. So I think at best case scenario, they can power on up. If the market can get some traction here, maybe make a new high, extend these divergences, and if that happens, we'll be stopped out. And we'll just revisit this one a few months down the road. That's it, or not, depending on how it looks. If there's better fish to fry, that's where I'll go. I don't take any of these trades personally. If they take me out and move on, if I still think it makes sense to go back and short it later, or I will if the risk reward is good. If not, I'll find something else to play with, long or short. Gold, not crazy about this trend line. I'm just going to go update the GLD trade we had. As I pointed out recently, there were a lot of potential bearish developments on gold. I kind of gave a heads up. In fact, let me look at the futures. You can see in the 60-minute we broke below this wedge. So it's all, I think, where gold goes from here. My views on the market, and I think what'll happen if the stock market continues lower, gold's going to break out. I think the correction will be over. Here's a trend line you can use on GLD. A pop above that could very well spark the next leg up. Even we did have the divergent high. Yes, this wedge projects or measures for a deeper drop, larger drop, but we're also about where we were back recently, what was this on? I put up last chart I could find, the 60-minute chart that I have saved is from April 13th, and I was warning about it then. We had gold was at risk of failing the breakout. We had negative divergences, bearish rising wedge. So for 1728 and the wedge broke, they would both go at the same time, bring us down to 1673. That's gold futures. I put a higher weighting on gold futures, or as high as I do on GLD. What did we hit today? Well, 1673. So there's my target. Pretty much, if we broke, which we did, there was a wedge breakdown right there. That's the bigger wedge. It was a smaller wedge here, big wedge breakdown, back test. Then all these were highlighted, I guess, in videos along the way. That's why I don't have the saved charts. Then we broke that. That was your next sell signal. So objective short entry or exit number 1, short entry number 2, short entry number 3 on a break of the minor trend line. And then we also took out this trend line. That's bearish as well. We broke down, back tested. But finally, remember, gold is in a bull market, a larger bull market. That's why, I'm recognizing bearish developments and pointing them out to you guys, but I'm also saying you get a big wedge like this in a bear market, you're going a lot lower, probably going to continue the next leg down. You get it in a bull market, that's it. We played out for what I believe to be, those divergences have met, they're a reasonable target, especially with the fact that gold's in a larger uptrend. So that's it. Point being, we've corrected. We hit that 1673 downside target if we got that break, and we did so. We've come full circle. There it is. You can see right there. Boom. Bullish divergences right there. So this would align with, what I'm looking at the stock market. The gold has now hit support and started to move off that level. GLD needs it, or GC, gold futures, need to take out these recent highs, and that should open the door up for a higher move. We'll watch this back trend line, maybe a back test of it, but it all depends on what the market does. I think the more the market drops from here, that should help gold as a flight to safety bid, and we'll just have to take it one day at a time. But long-term investors, as far as the official GLD trade, we're fine. I don't see any reason to change anything there. What I'm referring to here is on the daily chart. We've had an official trade on gold for a while. We went long back here the last time around. We've had several trades in the last couple of years, but we hit our third target there, made it halfway up here, almost halfway to the fourth target and current final target. And look, we pulled back also to that former T3 level. That's also an objective place for gold to hold that support level right about here and start the next leg up right there. So like I said, looks fine, and we're plenty of room. We're very profitable in this trade. I have not raised the official stop, but you should. It's just a matter of haven't gotten around to doing it. But when you have a gain of 18-20% on a trade, at that point, at the very least, your stop should be moved up to break even, if not somewhere way up in here to protect profits. So just kind of FYI stuff. LQD, remember I said don't expect the quick returns. We were in it before the Fed got their nose in this one here. We were able to milk that initial leg down, got very quick profits, booked them, jumped out, sidestepped this kickback rally, and then turned around, reshorted it, milked that move down. Those days are over now because the Fed will not let this one collapse. So like I said, if I didn't already have it as an active trade, if we didn't, I suspended the stops here that day because smelled a raid. I still maintain that the upside is extremely limited and there's more downside. I'm still looking for at least a backfill of this gap here, but it might be a slow move down. The Fed, they're not probably going to let it get down here or below anytime soon, but we still have the possibility to hit this first target. I mean, anything's possible, and like I said, I'll leave it on, but it's not one of my favorites. There's just not a lot of profit potential at this point, even if that gap is backfilled. I think we have an overweighted, double position size, so you'd still make another 5% profit, or recoup, if you will, let's say, of the losses if and when that gap is backfilled, which I think is a very logical and likely target at minimum. So I'm just going to leave it alone for now. So hopefully that makes sense. PALL, I already covered it in today's update, so there's not much else to say. I covered it in the video, put some static charts. Let's not cover that again. You can pull those, just go to the site and check those out. SGG, still unconfirmed divergent low. We need to be nice to get a little dip down here and then curl back on the PPO, but there is what we call, positive unconfirmed divergence. It was confirmed at that point, but right now the PPO is pointing lower. We're above the stop. Is it my favorite? No, but I do still like it. I do still think it looks okay. Here, let's look at the futures. And again, the ag commodities are a way to diversify, and you can see that what's happened here is we continue to make a series of divergent lows. This is SB, sugar futures. We had a divergent low there. These divergences continue to extend, setting the stage for what I believe to be a nice rally in sugar, take us up here to that 1081 level. If we can just get a little oomph going here, break that, and you can see these additional targets. So I do still like it. It is still an official trade, and it's still a trade setup. I still think it offers an objective entry here. We just don't have a hard buy signal. We don't see any. I don't see any type of strong evidence of a bottom, like a selling climax or bullish reversal candlestick pattern or anything like that. So it's one that I think I might have mentioned, just maybe scale into that. And if it starts to show us what we want to see, you can always add to the position and potential. We already hit our first target, by the way, so no matter what, it's a successful trade from that point, unless you're holding out for T2, in which case we just need to avoid that stop right there. I may change that to a stop on a daily close, and I would suggest that right now, whether or not I get that post out or not. Couple more. SPY, I already covered that because that was part of the markets. SSG, I continue to, kind of left it on here since it was stopped out because I shared my thoughts that I still really like the semiconductors as a short. I think there's along with that my theme that tech has been overpriced into this rally. Too many people chasing semis. I think the cycle is going to turn. I'm looking at a major, like I said, a major turn in the semis coming up here, and the profit potential is still very, very much all the way any of these former targets there. So I'll continue to update this, and we even added a semiconductor stock as a short, 27%. T1 was already hit, by the way. We already hit that target, but T2, and if we get up to that T3 level, you're talking 77%. But remember, this one's 2-time leverage, so it's really half of that, if you will. All right, couple more, and that's it. Verizon. Verizon, not much else to add. Playing out, it's profitable. I think most of our trades are profitable right now. Not all, but most. There was a weekly chart, a beautiful chart to me. We had a nice, clean uptrend line here, formed a big bearish rising wedge. We shorted the back test of the wedge, or just a hair below it, and then there's a little downtrend line, and so looks good so far. And yeah, not much else to add. Okay, we'll wrap it up here. This has been Randy Finney with the right side of the chart. Have a great evening.